Good afternoon, everybody. Welcome to our presentation this evening. Tonight, we are really excited. We have Stan Dreckman here from Huggins and Dreckman Insurance, who's going to be going over asset protection and insurance. As many of you know, insurance is, a critical part of protecting our assets and making sure that, what we've worked so hard to, generate and buy, that we're able to protect it in the event of unforeseen circumstances. So really excited to have Stan on here. Before we get moving, I always like to do a quick mic check. And for those of you that are on and that are able, if you don't mind just typing in the chat box that uh, audio is clear, just to make sure we're good there. And then I'll go ahead and take next steps forward. Awesome. Thanks guys for typing in for me. That's great. Great. Okay, so let's get started. Before we kick it off to Stan, this is always a good opportunity for me to just introduce Marshall Reddick and explain who we are and what we do. So for those of you that may be unfamiliar, Marshall Reddick is a full service real estate firm, and we have four primary services that we function in. So our first is real estate brokerage. So we help people buy and sell, whether it's a primary residence or it's an investment property. And we can, handle both. And we have awesome teams in multiple markets to assist with that service, right? Property management. So that's also a really popular and active service of ours. Is 99% of the investors who end up purchasing property with us, they are going to want to retain property management. And basically we handle the from start to finish, right? So from marketing the property, screening tenants, rent collection, rent disbursement, any kind of maintenance request we would handle. And then we also handle all of the end of the year tax, forms that you would need to file with your CPA to make sure all that's squared away. We handle all that on your behalf. And it really allows you as an investor to scale up and to focus on what you do full time for work, and allow us to take the headache out of kind of the day to day. So that's what property management covers. And then the last two, so private money lending and our investment funds are there. There's kind of some overlap there, but I'll go over private money lending. So we have a service where we lend money, and this is not like conventional lending. This is what some may call private money or hard money. And let me give you some examples of people that borrow money from us. Those individuals may be people that are looking to do fix and flips, right? Buy a property, put some money into it, and then sell it for a profit, or maybe refinance into a more conventional long-term type of loan. So that's a good example of folks that borrow from us. Another good example is, individuals that may have self-directed retirement accounts, right? So if you're, you have a retirement account that you control, you can buy property in that account, and you need a specific type of loan, which is called a non-recourse loan. That is what we would also be able to provide. So that's another good example of someone who borrows from us. On the flip side of that, we have lenders. So the same way you can invest in real estate, we offer the opportunity to invest in first position mortgages. So you can be the bank, you can be the lender on that, and instead of collecting a rent check as you would with real estate, you're able to collect a mortgage payment from a borrower. So it's a little bit of a different avenue, and we're seeing that that part of our business heat up tremendously, given that the recent bank jitters and the fact that private lending rates and terms have become a lot more attractive. And then our investment fund is a really cool semi-new opportunity we've been able to provide. The concept is it's been around for a long time because of our lending history, but it's just a new way to lend money. So instead of lending money in a direct capacity, one borrower, one lender, right now we're offering the opportunity to invest in our mortgage fund, which is a pooled investment. So you as an individual, instead of funding an entire loan or an entire project, you can have a piece of our fund, and our fund then loans to hundreds of borrowers. So you really diversify your risk, but it's all based under the private lending umbrella, right? So it's just a way to diversify your funds and to kind of spread the risk amongst multiple first lien position debt, and to generate a very decent and consistent return. Since inception of the mortgage fund, we've been operating just under 8.7%. And our target is 8% annually, and we feel very confident that we can continue to do that. So that's a little bit more about Marshall Reddick for those of you that may be unfamiliar. I'd like to quickly introduce myself. So my name is Vince Tomich. I'm an advisor and realtor here in the Newport Beach office in California. I know we have folks from all over the country on the webinar tonight. So, I'm born and raised here in Southern California, and my role as a real estate advisor is to essentially be a facilitator for all things Marshall Reddick, to help you guys in any direction you want to go: brokerage, property management, private lending, right? And raising capital for the fund. I'm here to assist in all of those and just essentially be a resource to make investing as easy as possible for you. We want to create this one-stop shop element, and I would be a go-to person for all things Marshall Reddick. So I got started in my original, before coming to Marshall Reddick, I had a background, or have a background in residential lending. I ended up was given a great opportunity to purchase a few investment properties, and that got me really excited about kind of pursuing that full time and further. And then I found Marshall Reddick through a webinar just like this, and attended and just kept attending these events, and found myself just so much more excited to be a part of this business and to work with other investors. And it's helpful because I like to practice what I preach. I've participated and been a client in every service that Marshall Reddick provides: brokerage, property management, borrowing, lending, in the fund. So it's really helpful for me to be able to just talk in first person and explain my experiences, as well as other investors that we worked with, so that if you are interested, there is that element of someone who's done it and has a bit of experience in that. So super excited to be in the role I'm in and to help you folks, and really excited to partner with folks like Stan to go over kind of more diversified topics like insurance and things like that. So before I do turn it over to Stan, I just wanted to kind of let everybody know the markets that we operate in. Here's a cool image that just kind of gives you guys a high level of where we can be the most valuable to you folks. So as I mentioned, I'm located here in Southern California in our Orange County office, but we have offices in, as you see, California, Texas, Florida, Tennessee, and Kentucky. And ultimately, this is what this is going to represent is boots on the ground, people that can assist. So brokerage, property management, and our private lending scope covers a lot more of where people borrow and where we lend, but this is like offices and boots on the ground more primarily for the brokerage and property management. So just in case you folks were interested in kind of where we operate, this is where you'd find where we'd be the most effective for you. And how do we choose these markets? What makes us go all in or commit further to these markets? And we put together a nice list here that we feel represents a healthy market to invest in. And some of these topics, as you see, are probably jumping out at you, but we want to focus on markets that have a good job market, right? Diverse jobs, multiple employers, so that folks have options and that we're not relying on one industry. We like to target places that have low vacancy rate. So places that are growing with population ideally is important for that. Economic diversity is also important, as well as housing affordability. So as I've been mentioning, I'm here in Southern California. As most of you may know, Southern California is a bit on the higher price point when relatively speaking to the country. So we like to target markets that also are attractive to those investors especially at a more reasonable dollar amount. Landlord friendly is critical. As a landlord, you want to make sure that that you have that you're protected as well. There's many states that definitely have more favorable terms for the tenant, and it makes that ownership in those states and counties much more difficult. So that's big for us. Strong education, always important, right? Good schools. That's a big draw for a lot of folks. And then last but definitely not least, reliable property management. We feel as though property management is such a crucial part to the overall performance of your investment, and we just can't say it enough how to protect you as an investor ultimately is the main reason, right? I know a lot of you folks may have hands-on experience and know how to fix many things, and but ultimately the reality is we want to make sure that we can separate you from the client and make sure to keep you out of any kind of legal predicaments. And as Stan will even go over, there's even incentives from an insurance standpoint when you're professionally managed. So that's pretty exciting as well. So, without further ado, I do want to introduce Stan Dreckman. He's been working with Marshall Reddick since the late 90s and has been an amazing partner for us. I've worked with Stan personally on an investment. I've worked with him with many, many clients. He's an amazing resource for you folks and for us. We're lucky to be partnered with him. And I want to turn it over to him to do a quick intro and tell us a little bit more about insurance.
Okay. Well, thank you, Vince. And yeah, we're going to talk about insurance tonight. This is going to be fun. I know it's insurance and fun, and those two words often don't coincide, but in this case, they will, I think. I hope you'll enjoy this. One thing I want to mention before we go any further is that what Vince mentioned toward the end, property management being such an important part of your investment program. It affects your insurance program tremendously, which, as Vince said, there are incentives in the insurance industry for property management rather than self-managing. There are so many traps out there as a landlord that you can fall into, whereas professional property management, they're ready, they know what needs to be done in advance. They don't get caught like you or I might get caught trying to manage your own properties. But anyway, moving right along. Why do you have insurance? It's to keep you safe from a financial loss due to an accident or a predictable event. Predictable event might be someday there's going to be an earthquake in Southern California. This can cause a lot of damage. Hopefully not in anybody's lifetime listening to this, but that's predictable. Yet you can buy insurance for that. So there's a lot of things that you can do from an insurance standpoint to reduce your risk, to make sure you keep your investment in your properties and your equity safe. Equity is an important part of that. This is the whole point of one of the points of insurance, rather, is to maintain your property, always put it back to the condition it was prior to a claim so that you have equity maintaining in your property. We want to rebuild, secure your property, and make sure that you are covered. So what does landlord insurance cover? Landlord insurance is really two policies rolled into one. It is property, your structures, the home. You might have, I was looking at one online today, beautiful home with a detached shed that had a gas pump next to it. It apparently was an original one, so it's interesting property. Contents, your rental income. We cover your rental income if you have a fire or water damage. Those are probably the two claims that are most likely to cause a tenant to move out during repairs. So when they're paying at the Resident Inn for a place to live, they're not paying you. So we're going to make sure that you are paid. And then the other half of the property of the landlord policy is liability insurance. You're sued basically for injuries resulting from your property ownership. The kinds of claims, there's a lot of claims that are covered under a landlord policy. It's a kind of policy we call a direct damage policy, which means we cover everything but what we exclude. The most common claims you are going to find as a landlord is what you see right here. Fire, wind and hail, vandalism to a lesser extent, water damage is your most common property claim from a broken pipe typically. And then you'll have a few other smaller things, but those four: fire, wind, hail, water damage, and then throw in vandalism. You have 5 reasons, really, 5 most common instances of a claim that will occur to your property: flood and earthquake. Earthquake here in Southern California and along the Pacific coast. Flood as you get more into the interior of the country, although this year we had our share of flooding out here in California for sure. But that's excluded. Those 2 coverages are typically things you will get from specialty carriers on the outside, not a part of your basic, what they call hazard insurance. Your liability is someone gets injured on your property. It's really that simple: bodily injury, some property damage. Bodily injury is typically what we think of. You have a neighbor or the tenant slips on an overflow from a broken water line early in the morning, going out to get the paper on a frosty day, and it's slick, and there's an overflow of water running across the sidewalk, and it's your sidewalk up to your door, and someone takes a slide on it and they land and they hurt themselves. That's an example of bodily injury. Something you don't think about is property damage. Water sprinklers are running all night and the tenant doesn't do anything about it, and the neighbors down below you on the slope get flooded out. So that's an example of property damage that could occur and has occurred to property owners. Not often, but it does happen. Property owners that we insure, that's an example of liability on a property damage side. A very important part of your liability is the third item we mentioned there. There's an item of coverage called personal injury in a liability policy. And part of personal injury is your tenant accuses you via the property management company of wrongfully evicting them. I mean, who knew they should be evicted because they didn't pay your rent? It has to be your fault, and that's what they're going to say. So you are defended, and if you lose, you pay. Or rather, a company pays, rather. Policy, well, we have a random mathematical look there, but that could be because of the way I set it up. I apologize. But here you go. What does insurance policy cover in terms of this is more structural now. The dwelling, we're using an example of a dwelling duplex built in Seguin in 2021. $355,000 to replace that particular property. $12,000, $6,000 aside for appliances that are removable. Loss of it, your rental income, you notice that's 10% of the property dwelling value. That's not of that, that's in addition to the 355, but the point is you see the structure. That comes down to that level, and you can see how they'll develop it. If it's not enough, then we increase it. It's very economical to increase it. Typically, most agents will put $300,000 of liability insurance in there. $1,000 of medical payments, that would be something where we would automatically pay it without them bringing any kind of a complaint against you. They slipped and fell on the newly mown, after the lawn was newly mowed, and they walked up the sidewalk, and again, grass that's been mowed and it's on a wet sidewalk is like ice, and they can hurt themselves. If it was a $400 trip to the urgent care, we'd probably pay that and call it a day. They want $400,000, we'll see them later, and they can sue you, and we will then defend you and pay the claim up to the amount of coverage. Deductible and we're showing in this case, the sweet spot on this one was $2,500. Wind and hail is typically a separate deductible, usually stated in a percentage like it is here. 1% in this case, or $3,550. This is a very typical type of a structure. Now, what you want to do though is you want to be cognizant of certain aspects of coverage that are important to you. This is where we start. At this point, we're going to start to break apart the policies a little bit and show you where some can be different, because not all policies are the same. People will typically call us and it's not uncommon for us to get an address and they'll ask us how much is the insurance. Well, it depends. So it depends upon what kind of coverage you get, what we suggest, what companies we use. All companies are not equal. They start from the basic concept I've just shown you, and it all looks the same when you get a piece of paper from 5 different insurance companies, but they're very different. These are some things you're going to want to make sure that are in and can be in all of your policies, or most of them anyway. First off, you want a replacement cost policy, new for old. The basic replacement cost in an insurance policy, when you have that coverage, says we will replace your property with like, kind, and quality. That means if you have brass fittings on your couplings for your plumbing, you're going to get brass put back on there again. If there's something newer and better, no, you're going to get brass put back there again because we're going to replace it exactly the way it was prior to the claim. Now, part of the replacement cost factor is, has anybody ever done a remodel to their own home, or had parents do a remodel? I guarantee you it costs you more than you think, more than your bid will say, because you always find things that are going to happen, that rather have happened with the property that you didn't anticipate. And so as a result of that, we provide on most of our policies, all of them, I think, unless we have a situation where we have to use an off-brand company, but we'll typically add what's called extended replacement cost to the policy. This provides you extra coverage, basically 125% of the policy limits. So if you had $400,000 policy and you had the endorsement that said we have $125,000, 125% extended replacement cost limit, you really have $500,000 of coverage. So that's 25% again of the 400,000, or a total of 500,000 when you add it all together. That's a nice coverage to have. That picks up your overages. Next item on the list is the third part of replacement cost. So the first part, 3 parts of replacement cost are: you start with the endorsement. With replacement cost, you add the extended coverage on there, and then you have what's called building ordinance. Building ordinance is an improvement to a policy. This breaks away from the replacement cost of like, kind, and quality. This is actually an improvement. This will bring you up to date with current codes. If you have a severe fire claim and you're putting the house back together again, the building inspectors are not going to tag your property as ready for occupancy unless you have brought it up to current code. And that's what this coverage is for. So that's extremely important part of your policy, and you always want to make sure you have that. So this is what a policy would look like if you did it the way we think you ought to do it. You'd have $355,000 of coverage on the dwelling. The extended replacement cost, adding in this case $88,000, almost $89,000 of coverage as a part of the policy. You would have $12,000 of rent-ready contents, loss of income still at $35,500, unless we need to increase it. You notice on the other policy, the common structure, they'll give you $100,000 or $300,000 of liability insurance. We recommend a minimum of $500,000. The main reason is that you need the protection. You never know where a claim is going to go. From a purely financial aspect, it's extremely inexpensive to go up from $300,000 to $500,000. Typically, think of McDonald's Happy Meal. That's basically the difference in the premium. So why wouldn't you do that? Extended liability picks up, and this will be under your rental contracts with your, your contracts with your property management companies. All of your property management companies are going to ask you to name them as an additional insured on your policy. There are reasons for it. We won't go into it now, but they're very sound. It protects both parties the best that way. And so you will find you should always ask for this if you have a property management company, because it's in your contract, whether they point it out to you or not. You are responsible. Medical payments, again, that's just a very small claim. Someone gets hurt, it's easily fixable. We'll pay it, not worry about it. Your ordinance of law, then your deductible. So this is really how it should structure out. This is how a policy should look to you. And for a completely unselfless moment, many of our policies will package. If we have your homeowner's policy, we'll give a discount on your landlord to create a package discount for you. So again, with your homeowner's policy, many times we'll be able to discount your landlord package by up to 5% depending upon the state. It's kind of a neat deal. Here is why also I want you to see some of these endorsements in action, why it's important to have them. Let's say you had a total scenario loss. That policy we're looking at $355,000. it goes down. You find out, according to the bid, that's going to cost $386,000 put back again. Most landlord policies will pay the replacement cost up to the limit of coverage and they'll stop. In other words, they'll pay $355,000, leaving you holding the bag in this case for an additional $31,000. With our policies, typically from us, we will pay the entire amount because we will pick up the increased cost due to the building code coverage requirements, and we have our extended replacement cost that allows you the extra limits of coverage. So I just wanted you to see, if you look at that, there's quite a difference. Think of that coming out of your policy, your own pocket. In addition to your deductible, you might have to come out with $31,000 if you didn't have the right endorsements on your policy that are very simple to put into place. Remember I mentioned that in these insurance policies, or what we call direct damage policies, they cover everything but what we exclude. We're not going to go over all exclusions here, but we're going to rapidly go through the primary ones. Earthquake, as I mentioned. Land movement of any kind is excluded. Floods, except in California, if you have a flood or mud flow after a fire event and you're in what they call a fire runoff zone, they'll force insurance companies to pay some claim level at that point in time. But typically, flood is not covered. Damage from freezing pipes while vacant or unoccupied. That's very specific, but something you need to know about, because sometimes you might have a tenant move out in February. And if you have a property, say in Indianapolis or up in the Panhandle area of Texas, it gets real cold up there. And your pipes could freeze. We've had a couple of Arctic freezes causing pipe bursts all the way down to the central part of Texas in Houston area 3 years ago. It's very unusual, but it can occur. And again, there's no coverage from day one for a freezing pipe that would burst unless the property has been winterized. And again, let me rephrase that. I said that incorrectly. There's no coverage for a freezing pipe while the property is vacant or unoccupied from the first day of vacancy, unless it's winterized. Your property management company will winterize that for you. They know that they are supposed to do that. That's what Marshall Reddick Property Management does. They have saved you right there your money for any fees you might pay them. Because if you have not done that, those snow angels, those ice angels look great in the middle of the floor, but they cause a tremendous amount of damage. Backup of sewers and drains typically is not a covered item. Now, you would think it is, but it's not. Some companies will give you limited amounts of coverage. Our Safeco policy in most states will give you $10,000. Travelers gives you $5,000 to $10,000 is your most common limit that you can get if it's available to you. But do be mindful of that so you know about these things. Pollution, mold, under the property coverage, most policies, while they exclude it, will carve back up to $5,000, sometimes 10, but usually 5 is your most common limit of coverage, 5,000 for mold that might be generated as a result of the actual water event, wall pipe breakage. It happens anywhere between May and October. It's going to be pretty hot in Texas, and mold will generate real quickly in the first 2 weeks. So any clearance, any cleaning has to be done as well with that. You have probably enough coverage for a very light mold event. Foundations, if they settle or sink, that is not covered. That's called settling and sinking, and we live on the earth, and the earth moves, and it just happens. If you have any unattached buildings, and if your tenant is operating a business out of it, maybe they have a car repair person working for AAMCO has his own little car repair on the side out of the detached garage, and he causes the garage to burn to the ground, there is no coverage. And property management knows this, so they're not going to allow that to occur. Another good reason to have property management. Damage by pests, rodents, birds, even damage by pets and other animals, with the exception of marsupials. Those would be your raccoons and things like that. If raccoon damages your property, you're covered. Short of marsupials, damage by pests and birds and and pets is not covered. So your property management company is going to oversee this to make sure your house is maintained. Again, property management comes to save the day. You must have them with you. Oh, and by the way, the reason I'm really pushing this is our loss ratios between property management and non-property management properties is quite significant. It's important to us. It should be important to you. Every time you have a claim, you have a deductible. Theft of anything not permanently installed is excluded. Example of that would be if you're in between tenants and someone breaks into the house and they rip all the copper out of the walls. Very seldom occurs, but should it happen, it's going to be covered if you have the right policy. If it's sitting on the floor, then no, because it's not permanently installed. It's not a part of the building. Claims resulting from lack of maintenance, wear and tear, planning, zoning issues, municipal issues, they're just not going to be covered. We can't cover those. Those are too random and irrational. So there you go. Where wear and tears occurred, property management can help you again, just like they can with some of those other issues we mentioned. They're there to make sure your property rather, is properly protected. This is a fun part. I hope you get some interest of this. If your tenant is in the growing business or in the production business, we call it, methamphetamines, things like that, and they blow up the house, there is no coverage for that. Just thought I would let you know. That's consistent with all of your other companies. One thing you can do, there's a lot of ways you can prevent rather this situation from occurring. It's pretty simple in most cases. First, go to item number 3, property management. If you self-manage, you've got a problem. Why? You're gonna have a problem when a tenant opens the door to you when you go out to visit to discuss the high water coming in on the utility bills. You don't understand how they could use so much water and they won't let you in. Second item, second magic red flag. You're looking at it. You accepted a 1 year's cash advance in advance in the rent payment. We had a neighbor across the street from us, a house in Anaheim Hills. It's a nice area of Orange County. People across the street rented it for cash in advance on the year. You can only imagine the difficulty with that property. So you never accept a cash advance. Your property management company won't let you do that. Again, property management saves the day. There's a lot of things we do when we look for the property. We want you to be aware of what we do. When we're establishing replacement costs, we just don't put our fingers up in the wind and go for it or go by the selling value, because the selling value of the property really has nothing to do with the replacement cost. It's close in places like Texas. It's a little higher. Your market value is higher in Texas than replacement cost in most cases, simply because of the attractiveness of the property. In California, it's not at all unusual for your market value to be a third or more greater than the cost to replace the house. It's market value driving that. So we look at various items. We look at the Marshall Reddick links. We look at Zillow. We look at Realtor.com. We look at the various types of the composition of the properties, wood versus brick, has a lot to do with costs. Quality of the interior of the homes for your newer properties and properties that are being held for rent. There's a lot of great video. We can see the quality of the inside so that we can make sure that we're properly accounting for the value to what it's going to cost rather to replace the property. All those things you see, interior floors, ceilings, patios, what have you. Everything you see here on this list, the things that we look at and more, but we're looking all the time to make sure we're doing it right. We're doing our very best not to overinsure you and not to underinsure you. Liability insurance is the other half of the landlord policy. Liability insurance, again, we discussed that real quickly. It's someone gets injured and what happens next. It's a very broad insurance contract that says we'll pay for all injuries that happen to anybody on your property. And then they start going through various examples of what they won't do. In other words, just like the property, we're going to cover you for all of this stuff, and then we're going to tell you what we're not going to do, and then What we tell you we're not going to do, we won't do. Everything else is covered. But the insurance company will not only pay claims for you, they will defend you before they pay the claims. So you're picking up, as a part of your insurance premium, you're picking up basically an attorney on retainer to help you out through any event. It's a part of the insurance contract. It's a very, very important aspect of the contract when you always need to be aware of, when you always need to know is there for you. How do you have a liability? You have a liability when you're responsible for an outcome, basically, especially if it's codified by law. An example of responsibility for an outcome is you have the neighborhood children running through your lawn and you don't have your sprinklers properly recessed into the ground and they're sitting too high and someone rips his foot all over it. And you have, $20,000, $30,000 medical bill. The insurance company the medical insurance company for the injured child might be paying the claim, but they're going to come back and try to pick up the claim from you because they paid for a claim that you might be responsible. Yes. In the insurance industry, they have this subject called subrogation where they will pay a claim, but if you are not responsible for the claim, your insurance company paid because it's a responsibility to take care of you. Then they're going to come back. Then that health insurance company is coming back against the landlord, in this case you potentially, and they're going to want to get reimbursed. So they'll bring a claim against you. You turn the claim over to your insurance company. They defend you, and then they settle. That's pretty much how that's going to go. Let's see. Here we go. Next slide. Here are some exclusions. They're very common. You're going to see these in all policies. Trying to make this as generic as possible. Expected or intended injuries, you would assume that any expected or intended injury would not be covered, and it is not. An intended injury would be something where, I'll give you an example outside of a property, but it's the best example I've ever seen. We had a customer back in wherever, I forget where this occurred. This occurred 2 decades ago. It was a long time ago. He got angry and he chased a motorist down in his car and threw a water bottle at him and hit him. And of course, he had a claim brought against him by a person who was injured, and we didn't pay a thing on the auto policy because that was an intended event that was done on purpose. So that's expected or intended injury. Results from the violation of the law and ordinances that you or someone commits on your behalf. That could be how you put the house together and it caused injury to somebody. Tip to you, professional property management will prevent that from occurring because they're going to make sure you are totally in compliance. So another reason why you want professional property management. Rendering or failing to render professional services. You may, you can't use this policy to cover you if you're in a professional situation, if you also have to be a professional realtor, for instance. Professional realtor is going to have their own professional liability. That's basically what this is about. If you don't have a location scheduled on the policy, in other words, we're insuring 123 Main Street in Seal Beach, but you find out that you're turning in the claim and it's in a different state altogether, but you happen to own it, you can't expect 123 Main Street to pay for that other property's damages. So we don't pay for punitive damages in California. That varies by states. We don't pay for your share of a loss assessment unless you have that special coverage with an HOA. We think of HOA losses as typically a condo policy, but when you buy a property around the country, more and more, you're going to have a common area HOA. And so what we do is we have the ability to place loss assessment coverage on your policy, but the liability itself will not pay for it. We won't pay for property damage to your own property. That's what your fire insurance is for. We're not going to pay for any claims where someone's eligible for workers' compensation. That would be handymen, things that come into your property. Use your Marshall Reddick Property Management Services. They're going to get an insured contractor or handyman to come on the premises to take care of your property. We're not going to cover boats and cars and airplanes. We're not going to cover daycare operations. We're not going to cover fungi, mold, and pollutant claims. Those are things we do not cover under liability. You can pick up some mold supplemental coverage in certain states. Texas has one, but it's extremely expensive. No one so far has purchased it that I'm aware of that we insure. We've insured thousands of properties. Tennessee and Florida, there's sinkhole coverage that you can pick up, which is interesting coverage that's specific to those states. In Kentucky, if you buy a place in Oak Grove, you can buy mine collapse protection. I don't think there are ever any mines in Oak Grove. You want to check with the property management people on that. Pretty sure there was never any mines in the area. But you get more towards the eastern part of Kentucky, you could have mines, and the mines could collapse and the property with it. So you can buy coverage for that, actually. So here's some tips I want to go through quickly because time's moving quickly as well. Some repetitive, but they're important. Some interesting, but we can do this quickly. Vacancy clauses. All insurance companies carry vacancy clauses. If after 30 or 60 days, depending upon your insurance company, they vary, you have to know what it is. If after 30 or 60 days of consecutive days of vacancy, coverage starts becoming suspended. Coverage suspended would include, in most cases, vandalism, glass breakage, theft, or attempted theft damage. That example I give you of taking copper out of the walls. Oh, and fire and water damage. Those are pretty important items, those two, particularly when the property is vacant. You need your property management company there to help you do a lot of things. First, get a new tenant in there right away. Secondly, to make sure that the home is the water's turned off and things are taken care of, so that you do everything you can to reduce that. If you happen to have an unusual situation, you get close to your 60 days or 30 days, again, depending upon your contract, you can purchase an insurance policy that will give you temporary vacancy coverage. We do that on a short-term basis and then roll back into your old policy when you have a tenant. And again, to repeat this, but from the first day of vacancy, there's no coverage if you don't have, if your pipes burst in the event of a freeze, unless your home has been winterized, and your landlord, your property management company will take care of that for you. That's what they do. That is your solution. Tip number 2, avoid after cash policies. After cash policies are basically depreciation policies. If you have, in this example, a $100,000 claim and you have an after cash value policy, the property is 30 years old, you're probably looking at anywhere from 20 to 30% depreciation on that claim, whereas a replacement cost claim will pay the $100,000. Deductibles, your best price points, and this is a moving target, by the way. It's starting to change in the current environment. As Vince mentioned, the insurance industry is moving up in their pricing a little bit right now. So there's ways you can offset that. Slightly higher deductibles can go real far to keep your pricing good and keep your cash flow good. Your 1 to 2 unit family homes, though, are typically a $2,500 deductible, $5,000 on the higher ones. And again, your wind and hail deductibles run from 1 to 2%. That is your typical structure and best price point. Pay attention to this because I'm going to contradict myself, it looks like, but I'm not when I go through this. When I go to the next slide, where and what you buy affects your cost. Higher rates, you buy stuff along the coast, is going to cost you more. It's just the way that it is. Why? Because you get into the Gulf and you get into the South, Southeast, you're subject to hurricanes. And you're subject to some heavy tropical storm claims, things like that. The more expensive areas are your Harris County area in Houston, certain coastal Florida areas, that's a hint on my contradiction, coastal Carolinas, again, coastal. Your claims, though, on your lower, your lower rates will come for areas like Austin, Clarksville, Oak Grove, Arizona, California, surprisingly, except for your brush areas. Indianapolis, Boise, all of these areas. Oh, Florida. Well, didn't I just say Florida is more expensive? No. When you work with Marcia Reddick, you're on the west coast of Florida. We did have a pretty tough hurricane this last year, but that's unusual. It's incredibly unusual. Most of your hurricanes come in from the east, and by the time they come to the west, they're just dropping rain. They're not damaging. So not as damaging. And you're buying newer properties, and so you're getting properties that are hurricane proof as far as they can be anyway. So that actually, the rates on the west side of Florida are very low compared to other places. So good place to buy property. What you buy affects your cost. Newer property costs less. Roofs. If you have a property that has an older roof, over 15 years with some companies, 20 with other companies, 25 for sure, the company's going to throw on depreciation schedules on those roofs. And it's going to give you a lesser of a return if you have a claim, if you have wind damage to that roof or hail damage to that roof and it's older. So it's going to cost you more. So the newer properties can typically be a better buy for you. 3 to 4 bedroom homes, those are key to you. I think 2.5 bath, 3 bath, up to 2,800 square feet is typically your best price point. Texas, they always go a little bigger, so that's different. But in most of your other areas, up to 2,800 square feet is usually your best purchase price. Don't buy a house with a pool. It looks great on the flyer, but it's a huge liability. Remember, a part of your liability exclusions, pools are not excluded, but a part of your liability exclusions are, reasons for liability is things for which you might be strictly held liable, things that if something occurs in an area that you can be held liable that you should have had foresight on, it's your liability and becomes pretty strict. Pools are strict liability. Someone gets injured there, even if it was a purely accident, you're going to lose that lawsuit. So what you also want to buy is properties where they have low or no claims history. Sometimes we can pick those things up when we're reading your policy out. It'll come up and it'll show if the insurance company that had the claim subscribed to Clue, and most of them do. Insurance scores affect how you purchase property and what you will pay. In California, it doesn't affect you at all because we don't have that here. Outside of California, an insurance score can affect the cost of your insurance. I checked out my own insurance policy I had in Clarksville because I couldn't understand why this one particular customer's rates kept coming in so high. So I ran him against my own property. The difference in the price was 50%, and it was mainly because he had a very poor insurance score. Insurance score is partially credit, but mostly claims history. Pay in full. Your mortgage company pays your premium in full for you every year if you let your mortgage company pay for it, but you're paying the mortgage company monthly. You're getting all the discounts that come with a full payment up front for your insurance policy. Yet again, repeating myself, but it's important to note, you're paying monthly to your mortgage company. It's a really good deal. I do it that way. Number of units. Many companies will not insure properties for you if you have over a certain number of homes that you might insure. AAA is a very famous company for doing that. If you have more than 6 properties, typically, it depends on the state, they will not cover any policies. In fact, again, cover any properties you purchase with their policies because you have too many properties as far as they're concerned. Some of our companies, particularly our Safeco program, we can insure a lot of properties. We have other programs as well that will do that for you. It has a lot to do with what you buy. Tennis dogs can really be challenging, your 6th tip, very challenging. Some companies will have complete exclusions for animals. Some companies will exclude certain breeds that have aggressive histories, and it's listed by the municipality, which isn't telling you a whole lot. So you have to look at the municipality range and what they have. Your realtor can probably pull that for you. It should be from the building and the safety department. They should have that information. You want to buy a policy that has no animal exclusions, and you don't want to buy one that has a sub-limit. Sub-limits are you may have $500,000 of coverage, but they only pay $25,000 for a dog bite. Dog bites can go much bigger than that. We just paid off at $100,000 on one. If you have a great tenant, but he's got a tough breed, or if you have a policy that has an animal exclusion, there are specialty companies. One of them is called Fido, based in Florida, and they will insure dogs. It's a specialty policy just for dog liability. And it's going to be challenging too. You want to make sure you have property management. That's the best way to make sure that you have a great experience with the tenant. Otherwise, you are going to be having a tough time if the tenant turns on you. Because again, using this example, I've never seen a tenant evicted who thought it was his fault. And you potentially could have an issue with that. Let me make sure it's done properly. Property management will make sure it's done that way. And if there's a problem, your insurance company should help you pay for that claim, should pay for your defense and pay for the loss. Rental income protection. Rents are going up. Make sure your rental income coverage that shows automatic on your policy is up to snuff. You want to make sure in this case, maybe it's no longer $15,000 of rental income. You might be getting 18 on this property now. Make sure you have the right amount of coverage. It's pennies on the dollar to increase that coverage. Huge, 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 huge item right here. Keep your information current with your insurance broker. Number one cause of unintended policy cancellations is the loan is sold to a new lender. You get a letter from the new lender and the old lender announcing how they have sold the loan to so-and-so. Well, many times, more often than should occur, the insurance broker is clueless about this. So your home has an impound account. Your new lender is collecting money while we are billing the old lender. That can create a problem for you. So you want to make sure that your policies don't cancel. That anytime there's a transaction, do not assume that the lenders have notified the insurance broker. Always call us. Always, always, always. And this is one of my favorite little tips. When it's a $500,000 more than $1 million, many insurance policies issue these policies, excuse me. Many insurance companies issue these policies on a commercial form. And they have what they call aggregate limits. That means the aggregate limit is the most they will pay in the policy year of 1 year. If you hit $1 million on $500,000 on one claim, you have 2 claims, one event, separate claims, or 2 separate claims in the year, your policy is done. Theoretically, and it's not a huge exposure, but it's something to be aware of. Why not have this if you can have it? You could have 4 or 5 claims in 1 year. Help us all if that occurs, but you could have 4 or 5 claims in 1 year, and each time you have $500,000. They're occurrent. You want an occurrence policy when all possible. You don't want to be restricted. So, professional property management, pricing, use your deductible strategically. Make sure your coverage is where you want it to be. Talk to us. We send you out data, things you need to know. We send you out checklists, things you need to know. Professional property management is the single most crucial, aside from your insurance policy, it's your single most crucial aspect to a good insurance experience, as it is with the rest of your rental experience. You must have excellent property management, or else no matter how much insurance you have, it's just not going to work out for you real well. And as Vince also mentioned, our rates are discounted with professional property management in place. Condominiums are pretty much the same. We're running short on time. Just remember, a condominium is pretty much the same as a single family home. Difference is we're not covering the dwelling. The other difference is your condominiums are coverage. Your master HOA policy does have a policy that will include your property into the inside. However, your CCNRs most likely will not allow them to do that. And the CCRs have the legal standing to trump what the master HOA policy says. So If the CCNR say you are responsible for all the interior walls, and you have an 1,100 square foot condo, you better get that $175,000, $200,000 of interior coverage, or else if you have a fire or water damage to the interior of that condominium, it's on you. It's not going to be on the HOA. So be aware of that, very important. Last item real quickly, what's an umbrella policy? This is basically extra liability coverage. You want to have umbrella if you can. And if you can afford a property, you can afford an umbrella. Those are pennies, $1 a day, $2 a day, usually in most cases the maximum. To cover you additional $1 million, $2 million of coverage over and above what you already have on your primary liability policy, just in case you have a bad liability claim that extends. We had a situation where someone fell out of a tree, trimming the tree of a property. I think this happened in Florida someplace. This is a long time ago. This is also a couple of decades ago. But these things don't happen often, but when they happen, they're whoppers. Working for a company fell out of a tree. As it so happened, the insurance company, the tree trimming company's workers' comp policy had lapsed. There was no workers' comp policy. They brought a lawsuit that the employee did against the property owner and won. I can find you 2 exclusions as to why there should have been no coverage under that policy within the umbrella and within the primary liability coverage, but the insurance companies paid a lot of money on that particular claim. And they do it also for 2 reasons: not only to get out of it as fast as possible, like they say on the commercials, but they do it to make sure they close the claim out in such a way, if at all possible, to relieve you of any further liability. So the faster they can get to it, less time people have to think about it, and the more on top of it they are, everyone's talking more quickly, we can get that claim closed more quickly. You always want to report an incident like that to your insurance company at ASAP. Make sure we can get on it and protect you as well as the insurance company. And this is kind of what an umbrella policy package will look like, just so you get a visual of it. You have your homes, your cars, your rental properties. Put your umbrella over the top to extend the liability coverage that comes from those properties down there, and the auto policy in your home as well. So we have we use Safeco and we use Travelers. This is information that shows you how you can get a hold of them. Safeco has 24/7, 365 service. Travelers has service as well. Excuse me, wrong direction. They're open 7 days a week as well. They're not 100% 365. They rolled back their service a little bit during the COVID period and just left it. And but they still are open 7 days a week for you to get a hold of them. Where you can go direct to both of these companies. And that's important. You don't pay extra for those services. We pay for you to have access to those companies, so that if it's 2 o'clock in the morning on Friday morning and I'm asleep and your pipes are breaking, you can call the insurance company and hopefully get a remediator out there right away as soon as possible to help you with that situation. Why us? We research, again, as we've mentioned, we check everything out. We make sure that you're insured properly. We have markets, many markets. We have brokerage relationships where we don't have markets. So we can always help you out. We work to keep you first and foremost. We put this together for you. Marshall Reddick himself had us put together this program for you in mind to give you the maximum amount of protection as much as is possible. So there we go. Thank you for listening.
Awesome, Stan. Thank you so much. That was incredible information, and we're lots and lots of good stuff here. As we close out, guys, I just wanted to give everybody the heads up that I will be doing follow-up calls tomorrow, and I will go ahead and we can those calls it can be as long or as short as you'd like. Ultimately, my goal is to connect with you, see what we can do to help, whether it's connect you with Stan, answer questions more. I know there was a couple questions here that we didn't get to. I was trying to answer some directly. Some are a little specific, so if we want, we can always set up a time with Stan or just kind of go over on a one-on-one capacity. But ultimately the point of the call is to figure out the who, what, when, where, and why, right? We just want to learn a little bit more about how we can help you. As Stan mentioned multiple times, property management is really critical. And, there's a lot of key individuals like Stan, like our lender, like our 1031 exchange accommodators, like our local agents, property management team. There's a lot of folks that are involved in this process. So we're happy to, if you are looking to grow your portfolio or add or even sell, we're more than happy to help assist and facilitate that. So that's a little bit more about the call. If you are interested in obtaining my contact, it's here on the screen. You can always call or email. We are so thankful for everybody that takes the time out to join these webinars, and we're so lucky to be able to host this education. We look forward with connecting with all of you folks. And Stan, again, I wanted to thank you so much. That was an amazing presentation, very detailed, and we look forward to reaching out to you folks. Thank you.